Good morning, everyone. Welcome to Lear Investment Management's December Market Insights call. It's a privilege here to host the call today. For those of you who don't know me, my name is Ryan Kenny, Vice President, Head of the Advisory Consulting Group here with Lear Investment Management. First and foremost, thank you for taking time out of your busy day to join us this afternoon. Lear Investment Management continues to excel for our high net worth clients and partners. And it's my distinct privilege today to join Jim Warner on our call. Jim's going to, over the next 30 minutes or so, provide updates from a macroeconomic and capital market standpoint, discuss some of the current themes in our theme-based high conviction investment strategy. And we're going to leave time at the back end for questions. So from a housekeeping standpoint, if you have questions throughout it, you can chat them into the chat function. You could email me or the team. If we don't have the time available to get back to you, we'll take it offline and our team will follow up. In addition to that, all of the slides and the video replay will be available and sent to your inboxes as soon as our dear friends with compliance give us the thumbs up to go ahead and do that. So, with all the housekeeping out of the way, welcome to Lear's December market update call. And Jim, I'm going to kick it over to you. Thank you so much for being here.
Great. Thank you very much, Ryan. It's fun to have you on the call. And thank you to everyone who's joining us today. As you know, I like to generally go through what kind of recently happened in the markets, and we'll talk about some economics. And then we'll get right into how we're positioning portfolios, particularly as we close out this, what has been a very good year for us, and start to look forward towards 2026. The fair question is, what's next? Basically, obviously during the last month, we had another 5% pullback. For anybody who's been listening to us for a long time, you know that 5% pullbacks happen all the time. One of the things that we talk about a lot is, was it sentiment driven or was it fundamentals driven? And really, it seemed to be more sentiment, and which isn't really, frankly, that shocking considering the incredible run that the market has had, certainly since April. It was time for a lot of people, including ourselves, to take some profits and to bank some gains, and certainly that's what a lot of people did. For those who remember, 2 months ago, we talked about how it is not 1999, and I would refer you back to that presentation, which, by the way, you can always get a lot of these replays on our YouTube channel. So feel free to search up Lear Investment Management and go back and see what we've been saying, because and hold us accountable for anything that we've said that didn't come true. Last month we talked about how the tourists were shaken out of the AI trade, and by that we mean, of course, the people that don't really do their homeworks, that just sort of follow the crowd. That certainly, and we'll talk more about that. But interestingly, this gave an opportunity for new sectors to outperform, like energy and healthcare. And those have been spaces that we've been adding to and really kind of like as we're going into 2026. So we, like many others, have bought the dip, and the market's now rallied back near record highs. And actually, since in the last few days, we've actually seen technology really kind of regain its leadership. So what went on with the AI trade? Well, this is a graph of our proprietary AI index, a bunch of names that are highly correlated to the AI trade. And what you can see from it is that it pulled back about 15%. Now, albeit this is after a huge run from the beginning of the year and certainly the April lows. And so really, frankly, was not a whole lot of, it wasn't really a big surprise. And we've sort of seen this trade bounce back about, nearly 10%. Now, what was remarkable about even the AI pullback itself, and what really dragged down the entire market, is that we can now divide the market sort of divided this AI trade now into two ecosystems: the Google ecosystem and the OpenAI ecosystem. Well, what's the difference? So in this top chart, this is the price index of both of these indices of these ecosystems. And what you can see is that the black line is the Google AI ecosystem, and this includes companies that basically are aligned with Google, that have lots of free cash flow, that aren't tapping the capital markets to fund their growth. And so this is now being perceived as more secure and more guaranteed. And you can see that it really didn't pull back, that ecosystem really didn't pull back at all over the course of the last month. Um, by contrast, the OpenAI ecosystem is much more reliant on debt and external funding, i.e., there's more uncertainty theoretically. And you can see that fear kind of gripped that ecosystem. And in this orange chart, you can see sort of this down and to the right pullback that has occurred. Now, it is since rebounded a bit, but I think that's the core thing that the market is trying to get its arms around. The poster child, honestly, for the OpenAI, because obviously OpenAI, and I'll talk about it in a second here, is a private company. So it's not actually in the index. But Oracle, as you can remember, back in its last earnings call, announced a 5-year, $300 billion deal with OpenAI, which is an enormous deal. And you can see the pop that Oracle stock did here in the black line. I've circled it right here. A $307 billion of market cap were basically instantly created as a result of this deal. Now, since then, and with these concerns growing over the health of OpenAI, and as they've cut these, almost trillion plus dollars worth of deals with various different companies, there's a real question as to whether OpenAI is going to be able to actually pay. And is this $300 billion even real? And the market is essentially, and then there's further concern over Oracle's growing debt load, which frankly is really not that big a deal. At 4 times, last 12 months EBITDA, yeah, it's levered, but it's not like horrifically levered. And they still have tons of free cash flow coming out of that company. It's very healthy even without this deal. Nevertheless, investors have gotten concerned. They've sold Oracle down considerably, and they even started to price the credit default swaps higher, as you can see on this blue bottom chart. And what this essentially means is the cost to insure against default on Oracle's bonds rose. It got more expensive. And what we've seen in the last couple of days is that the CDS price is rolling over. And I think as we see that and the market get a little bit more comfortable about the future of Oracle and the future of AI, OpenAI, I think you'll see the stock nicely rebound. It's actually one of our biggest positions now. Um, and they report this afternoon. So we're obviously very interested in what happens on that report. This is kind of a fun slide, but basically what I wanted, the point of it is, can OpenAI actually cut, are they cutting checks they can't cash? In other words, are they doing too many deals that they just frankly can't even think about making good on. And this is a fun chart, by the way. If you haven't, this was created by Nano Banana Pro. If you haven't used it, it's really fun. I basically just gave it a list of all these deals, and it spit back this pretty cool image. I'm not going to go through all of it, but they've done the Oracle deal for 300 billion. There's an $100 billion Nvidia deal. There's a deal with Broadcom. There's a deal with Microsoft, a deal with AMD. There's lots of deals getting cut. And so frankly, it's a viable and responsible question to ask is where's all the money going to come from? Today, as you can see over on the left, OpenAI is roughly valued around $500 billion. That was the last fundraising valuation. The revenue is probably a little greater than $300 billion on a run rate basis as they exited 3Q. Cash on hand around 10 to 15 billion. They're losing about $14 billion this year. Their CEO, Sam Altman, reportedly told investors in September that he projects to earn $100 billion in revenue by 2029, and the company will be profitable. But in the meantime, he expects to lose $44 billion. So what this basically means is they're going to have to raise quite a significant amount of equity over the course of the next couple of years to bridge this gap. And so now we have no indication at this point to say that that wouldn't be possible, but it's certainly going to be a question that we're going to have to evaluate. And I think this could create some form of a discount or overhang on some of the stocks that are in that OpenAI ecosystem in the meantime. So we'll see. All right, let's do a quick rundown on the economic data and the Fed, which obviously meets today. We'll talk about that in a second. It appears that we're in a sort of a no hire, no fire labor market. And as people know who watch this webinar, we focus a lot on two primary things, which is the labor market and inflation, because those are essentially the two most important things that drive interest rates and the Fed's decisions. Um, the labor market obviously is critical in terms of being robust enough to continue to foster solid consumer spending. And so far, it's fine. It's not great. And and if we look at the ADP payroll report, which frankly I think is probably a little better than what we get out of the BLS, it's not looking particularly healthy. We're not seeing massive job losses, but these numbers are pretty, that essentially you're seeing not a lot of hiring. And then if we look at the unemployment claims, they actually are trending favorably. They're trending lower recently. And that would just suggest that there's not also a lot of firing. So we're kind of in this weird place in the labor market where things are fine, not great, but people seem to have jobs and they are certainly still spending. Inflation. So also folks that watch this webinar routinely know that our favorite real-time measure of inflation is from a company called Trueflation, which has millions of real-time data points that they look at, and I think it frankly does a better job of estimating what is really going on from an inflationary standpoint. You can see the chart on the left that we've basically been hovering around the Fed's target of 2% for quite some time now. We can also see that that there really hasn't been an impact from tariffs. And I think this is an important point because when, back in April, May, whenever that webinar was, and we were dealing with all the uncertainty around tariffs, we came out and we said, look, we don't think it's a foregone conclusion we're going to get inflation from these tariffs because there's a whole bunch of factors that go into and levers that can be pulled. And sure enough, we were right. One of the things that validated that sort of drove that view was I went back and I looked and I said, okay, well, show me all the historical times that we've had tariffs and what happened to inflation, and it went down virtually on every. Inflation actually declined in virtually every case, and so it didn't really strike me that we were necessarily going to have it. Now we actually have a study out from the San Francisco Fed that came out about 2, 3 weeks ago that actually confirms that very analysis. So no inflation from tariffs. I think that's a good sign. The other piece that we've really focused on over the course of the last couple of years that has really been an area of elevated inflation has been housing prices. Now, most of you know what we think about how that process is, the data collection process and how kind of silly it is. But you can certainly see, at least from the data, that things are trending down, right? So you're going to get less pressure from housing inflation going forward. Now, I don't have a crystal ball, but there appears to be increasing pressure on home prices. And I think this upcoming spring selling season could really be perhaps the needle that breaks the camel's back. Why do I think that? It's a really tough market for home sellers. So this map, for example, on the right is from Realtor.com, and where it's red and big or orange is where basically sellers are calling it quits and are delisting their houses. 2025 is being dubbed by realtors as the year of the frustrated seller. Sellers were increasingly delisting their homes because they weren't getting the prices that they wanted. In October, which is the latest data point I could find, delistings increased 38% year over year. In Miami, for example, for every 100 new listings, there were 45 delistings. Well, people oftentimes play this game around the winter, right, where there's lower traffic and lower home sales, generally speaking, due to seasonality. And then so I would expect that a lot of those homes are going to come right back onto the market when the spring selling season occurs. So it's going to be a very interesting spring. I think you're going to see a ton of inventory, and that should force sellers to really kind of lower their price expectations, which up until now have really been far too high. Again, this would be great from an inflationary standpoint. Not so great if you're trying to sell your home. Uh, and yeah, the other thing too I'd point out is that this is a housing affordability and availability is a focus of the Trump administration. You probably heard of the 50-year mortgage, which frankly I think is a terrible idea. But there are going to be other things that the administration will try to do, certainly prior to the midterms, to try to, encourage home buying and whatnot. But in my view, the only real solution here is lower prices. Lower rates ain't going to move the needle much. Lower prices is really just the big lever that needs to get pulled. So we've got a big Fed meeting today and a conference call at 1. And the expectations are for nearly 100% chance of a 25 basis point rate cut. People have talked about a hawkish cut, what have you. The reality is that the market's taking a pretty nuanced view on rate cuts for the next 12 months. The Another 25 basis point cut is not even factored into the Fed futures market until the June meeting. I think that probably is the market's probably thinking that a new Fed chair will come in then. Now, of course, the Fed chair can't dictate policy. There's a whole committee that has to vote. But I think that the market is pricing in sort of that the Powell committee could be pretty much done cutting rates, and they'll hand it off to the next guy, whoever that is. But what you can see from this chart is that the view today at least is that over the course of the next 12 months, the rates will migrate down towards what most people think is the neutral rate of 3%. That means that the rate environment is no longer restrictive. It's just neutral. It's not easing, but it's not restrictive. And I think that is sort of our view is that it needs to get back to neutral. That said, these aren't huge moves, so it doesn't really have a big or important role in our portfolio and what we're buying. But overall, when the economy is solid, generally speaking, like it is, and interest rates are falling, you need to be involved in the market. It's generally good for markets. All right, let's talk quickly about 2025. It was a terrific year for us. Our performance was outstanding. What I showed here was, what I think is really kind of shows this year really showed how our tactical approach to investing as well as our stock picking really allowed us to outperform. Those are the foundations of the outperformance. These two, what you see in these charts here, I'll focus on one on the left. This is a year-to-date chart looking at the S&P 500, which is in red, versus our Global Vigilance Moderate strategy, which is this middle lighter blue, and our Tilt strategy, which is our more aggressive, more equity-focused strategy. Obviously, the returns have been outstanding. We've beaten the S&P pretty handily this year. If I focus in and on what happened right around Liberation Day, I think this is an important thing to and also help drive outperformance is that we didn't go down as much as the market. So our tactical decisions to raise cash to protect the portfolio certainly helped during a very uncertain period of time. And then we got right back in the business of taking risk pretty quickly. And I think that also allowed us to rebound faster than the market. So really good year for us, really sort of, I think, highlighted our strengths as investors. We were rewarded with more awards. Our Tilt, our Global Vigilance Moderate, and Global Vigilance Conservative strategies all received Top Gun awards from PSN for their 1-year returns. Tilt was actually number 2 in the entire category, beating 435 managers. These are all managers that their names and the big brands, and we had their number this year. Global Vigilance Moderate actually finished 4th despite being moderate, and Conservative even did extraordinarily well, coming in at 8th. So we're very, very pleased and happy about that. Okay, so let me wrap up with some thoughts on portfolio strategy. Certainly, as we go into 2026, our expectation is pretty optimistic. Why? Well, first off, there's a positive setup. We have a solid economy. Consumers are still spending. Uh, we have still, on average, a very low unemployment rate at 4.4%. That's still below the 50-year average of 6%. Then we have some cyclical growth sweeteners, I'll call them, with lower interest rates coming, and stimulus from the One Big Beautiful Bill. So this is, for example, come April or earlier when people file their taxes, a lot of lower income folks are going to get much larger tax refunds than they normally got because they haven't adjusted their withholding for some of the tax cuts that have come through. So that should be a boon for some of those households. There's obviously the accelerated depreciation schedules, which makes investments and all of the investment spending that we've seen announced become a higher incentive to do those things. And then we have these potential booms. So there is a massive infrastructure and construction boomlet in the pipeline. And this isn't just the AI data centers, which we talk a lot about and we're investing in. But we have a lot of commitments from a lot of large companies to build more facilities here. Last year was sort of the planning phase. This year is when the shovels start to hit the dirt. And this, I think, is going to be highly positive for the economy overall. Um, what we also know is that the power needs of this country are skyrocketing. Everybody's heard about this. It's massive. It's growing. It is the critical bottleneck. This is an area that we are still believe is a terrific place to be invested in. And then I think what this also contribute to is higher commodity prices, particularly commodities like copper and uranium, two very important commodities in our portfolios today. Um, I also think that we're going to start to see is the benefits of all the AI investments that companies are making through higher profits, perhaps accelerated revenue growth. This is where we're actually going to start to see kind of the ROI, if you will, on these AI investments that really have been going for, call it, the last 24 to 36 months. So being invested in companies that will really benefit from their AI investments is important. And then lastly, AI inference at the edge. What does that mean? That means that actually doing useful things on your useful AI productivity enhancing things on your mobile phone, on your laptop, at the edge. This requires different chips. This requires different cybersecurity. This can also really where you're going to start to see AI broaden out and penetrate more areas of the economy. And that's going to be a key theme for us this next year is that as we spread out from semiconductor chips and data centers, like who's actually benefiting from this? And many of you know that we've been making investments in healthcare companies or medical device companies and pharma to take advantage of that opportunity. So all in all, these trends I think paint a pretty favorable picture for 2026, and again, this potential broadening of winners. So what we've been doing, for really the last few months, is basically migrating out of the Mag 7 names and that exposure, and we think this will probably continue. And now what we want to do is shift, like I just alluded to where that AI tsunami is going. So whether it's inference, edge, or industrial and healthcare applications. I've talked also before about physical AI, IoT, robotics. These are going to be big, huge, powerful, new addressable markets that could spawn brand new companies, but also benefit incumbents. So we want to be there. We also want to be positioned and are for the booms that could happen, whether it's power, infrastructure spend, or industrial commodities. And then we're also looking abroad, and we've been increasing our exposure to Korea in particular, which I think should really benefit once we have a trade deal nailed down. They provide some really critical products to the United States, whether it's in the form of memory chips or shipbuilding. These are or heavy construction. These are all going to be tie into this whole infrastructure spend that we think is going to happen. So for those that don't, know, we are very thematic in the way we think about investing. So, and you sort of got that hint. I'm going to go into the themes here in a minute. But within those themes, what we're always looking for is what I'll call misunderstood value and bottlenecks, right? Wherever they exist in the globe in easily tradable securities. So, and it doesn't mean that we're value guys, but misunderstood value is where people don't understand the value that is about to come through the pipe for a particular company. That's what we want. So, um, this is our current themes. I'm not going to go through them all. You can read them on your own. But there's all sorts of themes beyond AI, like modern warfare. Gold is has been a terrific outperformer for us this year. Very important. Um, we have a new interest now in what I'll call specialized trucking. I'm not going to go too much into it, but it's really, really exciting. So we can always talk about that offline, or you can ask questions about it. Just real quick, reviewing kind of our four core strategies. Global Vigilance Tilt, our most aggressive. During the last month, we deployed the excess cash that we raised. Pretty good timing. And you can see that we're still we diversified, as I was sort of talking about, into more healthcare exposure, Korea, and trucking. We haven't had a trucking name in our portfolio in many years. So that's kind of an exciting new addition. Um, the returns are phenomenal. Year to date, our gross return is 38%. Vastly outperforming the S&P 500 or the ACWI, whatever you want to measure us against. Our Global Vigilance Moderate, kind of flagship product. This one tends to be in the range of like 40 to 70% equities. Um, it's sitting right around 60 right now. It's been pretty quiet on the trading front. We've done as much tax loss harvesting as we possibly could. There's frankly just not a lot left to harvest. Returns here have been phenomenal. Year to date, gross return is 30%. And I think the thing that we get a lot of questions about sometimes is, the performance is really, really good this year. Like, how have you done over time? And I think that's why we point to this 9.65% since inception, which is over 10 years ago. That should tell you that our process, which hasn't changed in that whole time period, is really effective and it works. It doesn't always, massively outperform like it did this year, but it provides in a moderate risk strategy a great way for clients to compound their wealth. That's what we take seriously around here is compounding your clients or irreplaceable wealth. That's really, the focus of this firm. And then the conservative, again, great performance, up 25% gross, fairly conservatively positioned. Also great compounded returns since inception. And then strategic income is sort of our way of getting kind of a high yielding strategy in client portfolios without taking the credit risk associated with high yield bonds. And so we do some unique things. We do have some high dividend paying stocks. That's about 30% of the portfolio. And then fixed income and preferreds are kind of the remainder. It currently yields around 5.5%. It's obviously very conservative. It's up, but it's up 9% this year. I mean, it's beating the high yield index. So let me, Ryan, let me stop there and see if we've got some questions.
Great. Thanks so much, Jim. There's a lot to digest in that. If you have questions, Jim, and you can view the questions here. Um, Gentleman, not sure how to pronounce the last name, asked, "Are we in a AI bubble?" Would be the first one.
Yeah. No. Um, I don't think so. I think certainly some of the names got ahead of themselves back in, October, November, and we've had a very healthy pullback. But bubbles happen when you don't have earnings to support the increases in valuation, right? And right now, the earnings are phenomenal. And we are nowhere as close to the types of PEs that we saw back in the bubble times of 99, which is partly, and I go through a whole bunch of that related to that question in that presentation, which I'd refer you to. But no, I mean, I think, look, stocks always can get ahead of themselves, but the earnings just need to keep up. And so far, whether it's, Nvidia recently reported, their earnings are phenomenal and they're growing like crazy. And so I think until we see, um, an issue with demand, and so you're not seeing the profitability really translate into the income statement. Until we see that, I don't think we have a bubble. I don't think we have a huge problem. We can get overcooked from time to time, but nothing that would, cause like a 50% drop. Um, so that's my view right now. That's clearly something that we're looking at every single day. But and just to share with you, like one of my comments that I made on that "This is not 1999" webinar was that, back then, if you remember, you had a ton of fiber that was just stuck in the ground and it was dark fiber. In other words, nobody was using it. So it was all these, remember of Cisco's valuation, 250 times PE, and they're laying literally cable in the ground and nobody was using it. That was a bubble. What we have now are massive amounts of spending on GPUs, and they're all used. Like we can't actually make enough of them right now. I think, frankly, that's all the evidence you need to know in terms of like where we are in this whole build out of AI. I think we are just in the earliest innings. But yeah, from month to month, from time to time, you can get a little overcooked. And then you have to play catch up with the earnings. But so far, it's just a tremendous amount of demand. In fact, I wrote a research paper a couple weeks ago. If you didn't get it, I'm happy to send it out. That was basically examined the corporate demand for AI, and it's very clear that businesses of all shapes and sizes they're using it in very sort of primitive and not pervasive throughout the organization. The one crazy, incredible thing about AI is that you can use it in literally every job in every department of every company. We've never seen a product like this, except maybe the internet. But this is a pretty remarkable time we're living in, and we need to be invested to take advantage of what could be a once in a lifetime opportunity.
Great. And we're having a number of questions flow in here. So just for an effort to time stack it up, here's one I like to share. If 4% unemployment is essentially full employment, and with the effects of baby boomers retiring and AI, why would anyone expect there to be a larger increases in monthly employment? So given the
Well,
current context of the labor market, why would anyone
yeah.
expect monthly employment numbers to go significantly higher looking forward? I think is the crux of that one.
Yeah. Well, look, I mean, I think every innovation, whether it was the personal computer or the internet or whatever, that there are certain jobs that will be eliminated. Like we used to have pools of people on typewriters in organizations. We don't have them anymore. Those people had to go find new jobs. So what AI is going to replace are a lot of jobs that are just simply tasks. Now, there are certainly some that will get replaced. But if you stop and think about it, like I think about my job, what I have some very manual tasks that I have to do, like building earnings models. And they're time consuming and it really doesn't take a lot of brain power. I wish I could just hit a button and I could have it produced for me. And then I could actually start thinking about really hard and digging in on the research to determine whether I want to invest in this company or what I think the earnings projections should look like, etc. right? So I think for a lot of people, what AI is going to do is massively enhance their productivity. Now, what would that do for me? Well, that means that I might find more profitable ideas and I could actually make more money and I can make my clients more money. So the reality is, I think I am very optimistic that the vast majority of jobs, people will get better at them. We won't replace them. But yeah, there'll certainly be some that will be replaced. And, we'll have to wait and see. But are we going to replace your lawyer just because AI can now draft an agreement? No, you don't want your lawyer drafting an agreement and wasting time on it. You want your lawyer to be thinking about what's being drafted, right? So I think a lot of people are naturally concerned. This is going to create substantial change. I think you have to be a person who wants to embrace that change and use AI and to make sure you're not replaced. But we're just gonna have to wait and see on this. How it actually lines up in terms of overall jobs in the economy. Look, the other thing too is this isn't necessarily just going to save costs and increase productivity. This is also going to grow revenues. Like whether there are many companies out there that are realizing like, wow, I now have some extra free time on my hands or extra, resources, even people that can now go work on a new project or a new product, right? Or a new service. So I don't think we actually know how this is all going to work out, but suffice to say that uh, I just don't view that we're going to see some massive spike in the unemployment rate, and it's certainly not going to happen overnight.
That's great. It reminds me of a podcast I listened to over the weekend. But to sum that up, if you break the white collar um, working class in our country into kind of two buckets, you have thinking professionals and you have task professionals. And where a lot of people are seeing the AI disruption is in those task driven, which you said doesn't take a whole lot of brain power. And let's use your brain to do things that actually require your brain power. And that's what I think we're starting to trickle down through the economy. So thank you for that. Another question. Oh, I love this question. This is my first call joining in. Thanks for having us. If I'm a new potential advisor, what's the best way to engage with Lear Investment Management? As this is the first time I've had exposure. I'm going to grab that one, Jim, real quick.
Yeah, please. This
Easy
is your
answer, reach
category.
out to us, reach out to our team here at Lear Investment. The easiest way to get involved is if you have an opportunity, if you have a client statement, someone you're thinking on an intricate type of investment case, send those over to us, and our team would love the ability to earn your trust in your business. Thank you for that great question. Um, Here's another one specific to the markets. What are your feelings on emerging markets, Jim?
Yeah, great question. We think that there's a few that we like, um, and we could argue whether they're emerging or not. But we're really big fans of India. We've been invested in India now for several years, and frankly, it's one of the world's fastest growing economies and one of the largest. So I think it's a remarkable place to be. Um, I wouldn't call Korea, I call Korea developed, so I won't include that. Um, we, have not done, from time to time, we have invested in Brazil, but we just have not found the right timing. Partly it's been the lack of stability in the dollar has impacted our willingness to go into emerging markets. Um, and obviously, the tariff situation has been, a very material issue for a lot of emerging markets. I mean, there've been times when we've done stuff in Southeast Asia. I mean, some of the tariffs were just usurious that were initially announced, and now you're getting trade deals. So, I mean, I think now is the time that we are starting to kind of look back at some of those emerging markets, but we've basically pulled completely out of them, save for India, due to the whole uncertainty around tariffs.
Great. So we are now button up against time. If there are any other follow-up questions, our team at Lear is going to be again following up with the slides and the replay after our compliance approves that. An easy way would just respond to that email if you didn't have a chance to type your questions in. If you have any cases you wanted to take a look to partner with, that'd be a great place to communicate as well. But I'm going to finish this where we started. Thank you. Thank you to our partner advisors. Thank you for some of our new friends. Jim, to you and the team, thank you so much for carving out the time today. Cheers to a happy and healthy holiday season for everyone. And keep an eye out for our 2026 Crystal Ball Market Outlook materials, which will be coming off the presses as we kick it into 2026. So, with that, everybody enjoy the rest of your afternoon. Jim, thanks so much.
Thank you. Have a great day, everyone.